Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to Vantage Point with True North Wealth Partners. I'm Andy Smith.
Eric Susi.
What, number 8, huh?
Number 8, episode 8. It's the 12th.
That's right.
February
12th, 2021.
So what are you doing with Becky? You gonna take care of her for Valentine's Day?
That's right. You know, it was funny. The last time we went out to a restaurant was Valentine's Day last year.
Boom! So drop the mic.
as a couple. So
that's great. I hear you.
How about you? You got any?
Nah, laying low. Trying to catch up in my sleep. Oh man,
the Seuss is loose.
The Seuss is loose. It's been a long, crazy few weeks here.
That's right.
Good.
Nice weather at least, so that's good.
Yeah. So, springtime, please. Enough shoveling. Anyways, yeah, let's get into it. We got a lot to cover, a lot of factual points, and I guess the COVID tracker, as you can see, still had a huge spike up there the past month. Curved over, you can see it bending down now, so that's good. Hopefully, this is the last big push of the virus spike, and I know you have your input or sheet there as well.
Yeah, well, you can see just from the tracker there some interesting data that says the first 9 months of 2020 show almost a 21% increase in homicides compared to the same period in 2019, the largest single-year increase in homicides since the U.S. started keeping records back in the 20th century. 20th century. So the COVID, the virus causing a lot of disruption and not just deaths from COVID, but other
stay-at-home orders and
ramifications of the virus, or ramifications.
I wouldn't want to be the mayors of New York or California right now.
A
lot of stuff's being exposed.
Crazy time, especially today in the news for sure. Yeah, and I was reading in like First Trust too. They were talking about the path to immunity, about there's the numbers as far as who's getting vaccinated, but they were saying that it looks like the number that we're closer to immunity just because of the people that maybe have had the virus that didn't get tested, and all that. You kind of factor in all that stuff, and so. But anyhow, but it's definitely good to see. It looks like we're making progress. People are getting vaccinated.
Totally agree. My folks did,
and my parents did. Yeah, yep.
We'll get there, folks. Keep the faith. Hang in there.
That's right.
All right. Well, good. Now moving on to a lot of factual stuff. So we're going to do some forecasting, projections, GDP, earnings. So we're over 80% through fourth quarter GDP earnings, killing it on the growth and earnings estimates. So well above the norms, which is great. Let me take a step back, just talk briefly about the quads as a remembrance. They're quad 1, 2, 3, 4. Quad 1, spring. Quad 2, summer. Quad 3 is fall. Quad 4 is winter. So the first half of this year, the first 2 quarters, we are in a quad 2. So as you can see here at the quad 2, it's just moving right along. So the party continues, the show goes on.
The show goes on!
And you'll see that. And yes, we're in it for now. So there will be a point in time. Things will lighten up. We'll have to change some allocations again. Speaking of that, briefly, we did, Andy and I over the past few weeks and over time, we've got the models rebalanced, the counts rebalanced, using a lot of thematic sectors, different plays that we're using for things that should do okay under the new regimes or agenda, what they want to get across. So obviously, you don't want to fight the Fed. You don't want to fight the trend, the momentum. So that's what we're focusing on now, such as just, like tips, treasury inflation protection, just things like that should do well, commodities in a rising interest rate environment, the EV plays, all natural resources, things of that nature. There's plenty of it. You'll see a lot of the changes in your accounts as well. And that's for that aspect of it. But going back to...
I thought we were just putting everybody in GameStop.
GameStop, I know. Oh, my gosh. Why didn't we? Hit the button, 400% return in a day or two.
Everybody just retire right now.
That's it, yeah. How about Bitcoin?
Yeah, crazy times with Bitcoin, right?
Yeah.
We get, everyone, we'll get a decent amount of calls about Bitcoin or just people, I think people just wanting to know what it is and how they can buy it. And And really all Bitcoin is, it's electronic cash, kind of in a sense. It's just electronic currency that it's fairly speculative right now. Obviously, it's not regulated by the government. It's not regulated by FDIC. You hear stories of people logging into their Bitcoin wallet and everything's gone. You know, people hack into it.
Right.
And so, we can't buy it. Like, we can't call Schwab up and say, hey, we want to put our clients in Bitcoin. No. You can't do it. So there are elements, though, of kind of that of cryptocurrency that we can get into. And I know there's talk right now of potential Bitcoin or cryptocurrency exchange traded funds or mutual funds coming together maybe by the end of the year. And so kind of our take on Bitcoin is that it's always best to be second. To kind of let things play out.
When it comes to things like this, amen, for sure.
Right. Yeah. And so just, we're being cautious and watching it from a distance, seeing how things play out. There could be an opportunity at some point down the road, but it's not something we want to rush into necessarily. But
we have indirect plays, though, with the funds.
Yeah, indirectly.
So that's what we're doing. So we have that exposure throughout the funds that we're using. So
that's right.
We got some exposure, but not the direct play of Bitcoin. So.
That's right. Yeah, because, Bitcoin's exciting.
Right.
It's quick. It's fast. Building wealth in a well-diversified portfolio is boring.
Yes, it is.
It's slow. It's
slow. The turtle versus the hare. Who wins the race? The turtle.
That's right. So, but hopefully, again, it's something that we're aware of it and things we're watching, and we'll communicate more.
Yeah, I hear you on that. So, just moving back to the overall GDP, so forecasts. So we started out, our take on a lot of different things was the S&P 500, how things, again, all you do, any forecast, economists, all the research strategic partners that we use, it's best guesstimate. So with the information you have at the time. So we're still sticking to our 8-9% return in the S&P. And it could be a lot higher, i.e., remember we mentioned earlier on other episodes, 15-60% for the S&P from other firms that are out there. But GDP, all based on earnings and GDP. So Goldman Sachs, they've increased. You want GDP greater than 0. That means you're growing. Obviously for 2021, the forecast for Goldman Sachs is now at 6.6% GDP growth. Ned Davis Research, 4.6%. First Trust, 4%. August Research, 5.1%. That's phenomenal. I hope they're all right. That means we're all making a ton of money. So that's great, but
so what's now back up so GDP? What does that stand for?
Gross domestic product. So it's just overall how the economy is doing. You just want it greater than 0. So all these firms I just mentioned are all low mid single digit returns, which is fabulous. Mm-hmm. So we're coming off a decline of over 3% GDP for 2020. So if you go from minus to a positive, and get to the even 2%, 3% range would be great. But so. Like I said, the first half of the year, that's where we're going full boat for now. And with that said, the Federal Reserve, Bank of Atlanta, they put out the GDP Nowcast. So they revise that every so often. And right now, the first quarter GDP, the forecast is 4.6% from them as well. So, things should be good. It's going to be still volatile, and you're going to see volatility still have its spikes. We saw that a couple weeks ago, and then right now it's a lot of sideways trading going on. So it's retrenching, burning off the excessness in the markets. So that's how you do it. Either you have a pullback or you go sideways, and right now we're in the sideways. So that just sets us up for the next leg moving forward. So when spring, summer comes, that's why we have thematic sector plays, even the travel, airlines, just things like that. Yeah. I mean, it's out there.
Dayhagen.
Oh yeah, Dayhagen.
SSUS,
yeah, that's great fun, and they have exposure to that, and they rebalance it on a monthly basis too. So it's fabulous. So I guess we still have the K-shaped economy that's out there, and it's still being propped up. A lot of spending, low interest rates, et cetera. So the 1.9 trillion stimulus. Okay, that's for that. Assuming that goes through, then you have then you want to talk about almost $2 trillion for infrastructure play. Great, you're going to have infrastructure exposure as well. So there's a lot of stimulus, government interference, which will keep the party going for a little while longer. So you can't fight it. You want to participate in it, and that's what we're doing. And so just be aware of that. But there's consequences eventually.
It's a lot of money being put out there. So yeah, what's the consequence of that?
I mean, it's called inflation. So inflation, a lot of different charts, and you'll see this. Again, run multiple calls throughout the weeks, whether it's NDR, Ned Davis Research, or Dayhagen, or whomever, even Schwab on their calls as well.
Yep.
But right now, NDR, and you'll see this on your reports coming out, the 10-year, they predict fair value is 1.95%, 1.95. So we came off the 0.5 low. We crossed the 1%. We said 1.5. We should hit that easily this year, and we'll see if it gets higher than that 1.75 or onward. But you'll see how it is projected to move forward. And then with inflation growing, it has to be measured. If it's small increments over time, the markets can digest that. If not, if it's a spike to the shock to the system, markets won't do that like that per se, and there'll be more volatility and pullbacks and / corrections. Again, how you offset that's using tips, commodities, other instruments that we have for our funds and for our clients, and you own that. So do the best one can, and
I'm already seeing it too at the grocery store.
It's ridiculous.
Just different, just paying more for goods, right?
Oh yes, wow. And again, this is coming from Dayhagen, a webinar I was on this week. So it talks about the cash sidelines being fully invested. So just right now, people are fully invested, and we're back into the markets as well, fully invested, et cetera. And with that said, this is an interesting factoid. Pensions have only 2.6% in cash. Pension, okay? That's the lowest since 1955. That's incredible. So, these pension folks are trying to eke as much return as they can, but they're also fully leveraged.
Yeah,
So that's
good and bad, right?
Good and bad. Amen. Next, mutual funds. Less than 2% are in cash, or meaning they have 2%, less than 2% are in cash, against the lowest since a record low. That's record low for funds. And then the short interest ratio is now 1.6%. So you go long, his market's going up, short is down. So because it's down so low, 1.6, it's the lowest since year 2000, which was 1.5. So again, the show goes on. So we're going to ride these ponies a little bit longer, and that explains why the short interest ratio is so low for that reason, because the party will continue for now. Moving on to a little bit of the green energy and all that stuff. So there's a play to be had on that. So you'll see through this slide here. It's pretty interesting. So Andy, Russ, myself, we went to this forum last year. It was actually put on by First Trust, one of our strategic partners. And as you can see, you hear about the Green New Deal and all that, and the clean air and what have you. So it's interesting, folks. So what's fact versus fiction? But you can see USA, we're one of the cleanest countries in the world, okay? So you can see that on the green chart there. And then you have your middle of the road, the yellow Germany, the EU, and that falls into even Russia is there in the yellow range. Orange, that's South Africa, Mexico, Zimbabwe, okay? Then red, okay, that moves into India and China, okay, fine. So they produce the most, those two combined, almost the most. And then you have the dark red, that's Egypt, Nigeria, Chad, those located in Africa. So as one can see, all these plays, that's why we're doing the EV play, and the Ford's getting into it, spending all that money, and Apple signing deals with Hyundai and Kia. So autonomous cars, EV, it's here to stay. The genie's out of the bottle. So we're going to play in that space. And so the commitment is to be neutral, green, what have you, by 2035. I find that interesting. We're already green, but hey, folks, let's put it out there.
Yeah.
But China is good. They don't have to be green until 2060. Okay, so they're one of the worst polluters. So another thing, that's why we're in minerals and minings and all that, and nickel, because copper, it's 4 times these EV cars takes 4 times the amount of energy from that. And so
EV is just environmental friendly.
Electric vehicles. Sorry.
Oh, okay.
The Teslas of the world.
Okay.
Yeah, environmentally friendly. Sorry, but but it's interesting when you really peel back the layers and look at this, and you can see. So just stay informed is what we're saying. And, to fill up the food basket, as you can see, grocery prices index. So that's going higher. That's why you have commodities, the second pane window. And then the last one's the water. So we have a play on that as well. So the Great Lakes represents about 84% of the freshwater surface in America. So these are just thematic themes and sectors that we're utilizing, things of that nature we found to be interesting. And we were waiting for a time to deploy it, and now is the time. So.
All aboard!
Yeah. So you go out and buy your Tesla.
Yeah, right. No. What else is on your mind? What's going on?
Oh, well, I know there's a lot of talk about the GameStop.
Oh, boy.
Right. So that was big it kind of died down over the last week
And
or
the
so.
Reddit, yeah, how that pushed people.
Yeah, the Reddit, some of the activists investing, and so we're starting to see some of that. Obviously, it caused some volatility in the market. Short term, we kind of knew how it was going to end, and it seems to be ending that way, unfortunately. But yeah, when you have people, you might have heard on the news, talking about, they're trying to squeeze the shorts. And so when you buy a stock, right, you say, hey, I want to buy Ford at $5. I sell it at 10, I make $5. So if I have one share, I make $5. If I have two, I make 10. So when you short a stock, you sell it first and then you buy it. So you're anticipating the price going down. Yeah. And so in hedge funds, that's a common strategy, because a hedge fund it's kind of like a unmonitored, in a sense, mutual fund. Right. They don't have the regulation that a lot of mutual funds have. And basically you give a hedge fund manager, usually there's like $1 million buy-in minimum. Here's my $1 million, make me money.
Yeah.
They don't have to tell you what they're doing, how they're doing it. And so one of the tactics is they'll short the market or short stocks. And so these groups were like, hey, we're going to go buy, by buying stock, they're driving the price up. So if they were shorting it, they were losing money. So
adds to the herd mentality, forces everyone up. And
so they had to sell, or they had to buy, I guess, to cover their position, because they're in a sense they were borrowing the shares. So that's kind of a quick look at it. But anyhow,
hedge fund went out of business. I think it was $2 billion, I think it was $2 billion it cost them. So
and there's hundreds of hedge funds, and so there's kind of this mentality that their mindset, they're kind of bad, but they're just, it's a way to invest. But anyhow, so we might see some more of that, but we wouldn't, again, it's a short-term volatility kind of news that's driving the market. But
what's interesting too is, with the bonds and low rate environment we're going to be in for a while, et cetera, people are really stretching to find yield.
Yeah, that's right.
Finding that in high yield. So obviously we have exposure in high yield, but we're using short end high yield. We're not going long, traditional long end high yield. So just to add more flexibility to it.
So what short term does that mean?
Under 5 years, primarily.
So debt matures within 5 years.
For the most part, yes.
Right.
Rather than going 10, 15, 20 years or longer out. So just to be on the short end, be more tactical, a little more nimble in a rising interest rate environment, things of that nature. So, but yeah, it's the first time ever the high yield bonds have dropped below 4%.
Wow.
That shows you the demand. So when people are clamoring for high yield, okay, they want it. There's not enough supply, so it just drives it down. So it's amazing. So that's something that again people are stretching for, and it's something to be aware of, and we're aware of that. U.S. economic growth, GDP year over year. So like we talked about that as well. This chart, as you can see, just shows that how it went down. Minus over 30% in the second quarter, third quarter up 33, fourth quarter positive 4, but then negative for the year overall. But then going back to what we mentioned earlier, how we anticipate a good solid GDP for this year, and heading into rates, the 2-year, 10-year spread. So again, jumping back a little bit, but using this chart, this shows you the 2-year, 10-year spread, how 1.19. Heading to 1.5 and probably going higher thereafter. So short end, the 2 year is going to be level and flat. It's not going to move a lot, but the longer end of the yield curve, the 10-year, 30-year, that's going to move a little bit more.
Yep.
And we're seeing that. So hence why you have to have commodities and tips and things to protect you for that. Also volatility, we briefly talked about that. So volatility, you can see it spiked up at 83 range during the COVID, it came back down. You can see all the bumps up, high, low, high, low. A couple weeks ago, we had a little spike up in the 30, almost 40, hit 40 actually, about 2 weeks ago. And now we're down closer to the 22 range. The average basically is around 18 is the average on the volatility index. That's just volatility of the stock market over the next 30 days. So you're always going to have volatility. Again, pullbacks are common. You have at least 5% pullbacks during the calendar year in the S&P 500. So remember that, folks. Don't freak out when you see the 5% pullbacks in the S&P. That's normal.
It's good. You want to see it.
Yeah, Remember we talked about how you go sideways trading, so you burn off the excesses, or you have these pullbacks and or a correction. So pullbacks are okay. Sideways trades are okay. That's just normal. And then just talking about the federal funds rate, how they're going to be lower for longer. So they want to keep rates low. But we'll see. Maybe by the end of 2022, they may have to act earlier if inflation really does start to take off. So hopefully they can wait till 2023. But time will tell on that aspect of it as well. I guess let's move on to tips of the month. What's our tip of the month here? The Super Bowl? No.
Yeah, that's right. That's right.
Tip of the month, interesting. As far as demographics, so Neil Howe is part of the Hedgeye, one of our strategic partners that we utilize. They mentioned the low birth rate. So a lot of countries, especially foreign countries, are really hurting for China, Japan, not enough kids, and to support the older population. So here in the United States, we have it as well. So the upshot's this. The first look that they're getting on birth rates during the pandemic in 2020 came in, it fell by 50,000 births over a year earlier, and that's just from 5 states. And Ohio is part of it: California, Ohio, Florida, Arizona, and Hawaii. So when you extrapolate that out, it represents this would be about a 5.3% decline in total births in 2020. So
not good.
Not good, and with people retiring, the Social Security, labor force participation rate not back to where it was at the highs. A little over 62% range. So currently. So you need more workers back in the workforce to support the folks who are on all the government programs, et cetera. So, we're all for legalized immigration. Yes,
we need it.
We need it, but it has to be done correctly. But so these are just trends and things to be aware of. So I thought maybe that was an interesting tip of the month. And with that, with that said, I guess next month we'll have more out there to uncover. And again, we talked to Larry Williams, who mentioned getting into February, early March could be some more volatility. We'll see how it all shakes out. That's in the near term. Just remember, we're invested for longer what's coming up. So we're still in Quad 2. The show goes on. We're going to hang in there. And then might be another reallocation later in the summertime, we anticipate. But for now, we'll continue onwards and stay well, safe, and wash the hands. We'll get through this and bring on springtime.
That's right. Thanks, guys.
Take care.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.